This is being recorded, and I say that at the beginning of every single webinar, although sometimes I say that and like last week didn't record it. But this is being recorded this week. And one thing I've mentioned at the beginning of all of these is watch this webinar again relatively soon after so that you commit this to your long-term memory. If you wait a month down the road, it's going to be like relearning it all over again. So we tape it, we send it out to you guys, and please watch it again. Yeah, you might think that you've got it down pat, but believe me, when you watch it again, it will solidify that into your long-term memory, and you'll catch some of the nuances that you might have missed the first time through, because the way I teach might be different than what you're used to hearing, and I have several rules that a lot of people won't be talking about. So you're not going to be able to find that stuff online if you go and try and review it again. You can also watch a different Poor Man's Covered Call webinar, because sometimes, you know, like I said, I like to shoot from the hip. I may miss some of those nuances in one webinar to the next. So, and your questions help. So a lot of times when you're bringing up questions, that brings me back around to it. So throughout this webinar, feel free to ask any questions, or if you catch me misspeaking, believe me, I get ahead of myself and I sometimes say the wrong thing, not meaning to say the wrong thing, but it just comes out that way because I'm thinking of the next thing to say. So please reach out. I want to make sure everybody's clear of concept before we move on. So let me get a couple of things out of the way real quick. My name is Eric Wilkinson. Some of you guys may recognize me as a Wolfman from CNBC, Fox Business, or even the Wall Street Journal. For my commentary on everything from economic to geopolitical and market analysis. I started out in college with a psychology degree and was trading some money that I had earned in high school and decided to switch it over to finance. After graduating from finance, a buddy of mine, or after graduating college with a finance degree, a buddy of mine was like, literally, Eric, you would be perfect for working on the floor of the Board of Trade. Here's a number, go up and talk to this guy. He'll get you on the floor. And that's what happened. I literally was walking around the floor, never made out a resume, and was handing out my phone number and got a job that day. So that's where I've been, or that's where I was for about 20 years afterwards, until about 2015, I think it was, where I decided, okay, going down on the floor for an office is not as much fun as it used to be. So I've been trading on the from my home office ever since, basically. But any opinions, news, research, or analysis, or other information contained in this webinar, or information provided by ProTrader Strategies and or associated companies or employees, is for general commentary. You guys, we're here to teach you guys these things so that you can just go out there and do it whenever you want. If you know the rules, you know what the environment is, all of that stuff, you can implement this into your portfolio, okay? The reason why I can't tell you to implement a specific strategy around a specific underlying is because I don't know your risk parameters and I don't know what's in your portfolio. So at the end of the day, we all have to be big boys and girls and make sure this stuff is appropriate for our risk parameters and our portfolios. Anyway, bottom line is, do your own homework. Past performance of any trading system or methodology is not necessarily indicative of future results. What's that manual says? For logistics purposes, how long is the seminar? Thank you. Manual, I try to make these things about an hour long. Sometimes I go a little bit longer. I try and wrap it up at least with an hour, within an hour. But a lot of times I like to answer some of those questions afterwards. So, you know, it's up to you guys. I'm not gonna leave anybody hanging, okay? So if you guys have questions on the strategy, even after the webinar is over, I'm going to stick around for you guys. All right. Because like I said, I want to make sure everybody's clear of concept before we move on. All right. You guys can follow me on Twitter. I've been a little bit more active on Twitter lately with some snark and other market wisdom. Hopefully, ProTrader Strategies definitely will be offering up some market wisdom. The other thing is, during earnings season, you guys, I tweet out what my earnings trades are based on my rules. So I'm not going to tell everybody what my rules are out there in Twitterverse. But, you know, if you guys have watched the earnings webinars, you guys will know exactly my strike location and what I'm doing there. All right, let's get this real quick because I know we've got a lot of new faces. And this is the beginning of the webinar series. So I want to make sure that everybody's clear of some of these little nuances and easy ways to remember them. Like if you guys have struggled to learn what some of these Greeks are, like I did back in the day. I mean, of course, we all have some problems with learning the Greeks, but I've got some easy ways for learning it. Delta affects the option premium in relation to the first dollar move of that underlying. So what we can do is pull up the option montage. Hold on, let me pull it up. It's on the wrong screen right now. So we pull up this option montage. Right now I have it up for IWM. So this is the option montage. If you ever hear me refer to it, it's basically everything on this page. And what we need to do is go to the option montage, pull it open, and switch this so we have the delta, gamma, and all of that stuff. So basically what this is telling us here is if we are looking at the option montage and we have delta and gamma and all of that stuff over here. So you can see at the top here, this is what we're going to be referring to: delta, gamma, theta, and vega. All right. So right now we're talking about delta. Delta tells us right here, this whole column tells us what the correlating strikes over here, okay, will adjust the premiums for every dollar move. Okay, so that might be a little bit confusing. I tried to say it a little bit different that way than I normally do. But basically, delta tells us if this underlying 155.61 goes to 155.61 to 156.61. Now we're trading 156.61. Each one of these strikes has a premium, as we can see, correlated to their premium. All right, let's just go to the first ones out of the money right here, 156. These premiums are $2.52 is middle of the road, $2.51. I'm going to make it because I can see the math is going to be easy. So this moves up by $1. Okay, we move up by $1 increase to equal that. This premium goes from 251 and delta goes into it. So now we're at $3. Okay, so this first dollar move higher to 156, this premium increases by 49 cents. Vice versa, if we look over here to the 155 puts and this goes up by $1, the delta is negative 45. So we've gone up by $1. We need to subtract 45 cents out of this premium. Okay, so if we subtract 45 cents out of this premium, we would have $1.75, right, on this bid. You know, I'm kind of going middle, trying to go from the bid anyway. So decreasing by 45 cents. Now this premium would go up to $3. This premium would decrease to $1.75. That's just for the first dollar move. And if we looked at it from a different example where this went to 154.61, right? So delta over here is positive, but now we've gone down by $1. All right, we've gone down. So now this is a negative to the premium. All right, so you subtract 49 cents out of this, and we're going to have $2 and what, 3 cents or 4 cents, something like that, depending on if you're going middle of the road. So if we go down by $1, this premium decreases. Vice versa, this one, it goes down by $1. Well, that's a negative plus a negative, so it's a positive. So this goes to $2.65 on that dollar move down. Okay, so delta tells us what happens to the premium on that first dollar move, whether it's positive or negative. Okay, does that make sense for everybody? Can you send me the link for the last webinar? I missed the long call. Thanks. Eileen, I screwed that up. Please reach out to us at trading@protraderstrategies.com because I forgot to record it and had to re-record it, and that's might have been the whole snafu. So if anybody missed that last webinar, I talked about it right before the webinar. I threw myself under the bus for that. I fully admit to messing that up. All right, so that's delta. Affects the premium in relation to the first underlying move, the premium of that option strike. Gamma is the rate of change to delta. So we can pull up the same platform again because we saw the delta or the delta and the gamma. So this is delta, this is gamma. All right. So gamma, a way to remember gamma is it just goes with delta. All right, it goes with delta on the second dollar move. All right, we talked about the first dollar move on that first one. Now we're talking about the second dollar move. So the first dollar move on this premium here, we talked about it. It went from $2.50, increased by 50 cents. So we were at $3. All right. So we were at $3 on the first move. That was on the first dollar. Okay, increase. Now we have the second dollar move. All right. So now this underlying went from 155.61. You know, it was 156.61. Now we're at 157.61 here. Okay. So on the second dollar move, gamma goes with delta. So this second dollar move is 55 cents. Okay. So now on the second dollar move, our premium on the 156 strike is going to be $3.55. Okay. So gamma goes with delta. It adds into delta. And if it's a negative, right? If it's a negative going down a dollar or that second dollar, then gamma goes with delta. But because it's a negative, we would have subtracted out. So the second dollar negative, this delta would be equivalent to 43 cents. Okay. Is everybody following me with that so far? So, you know, just think about it like with math. You know, a negative, whoops, if we go a negative plus a negative plus a negative equals a positive, right? Same thing with this stuff. If this is positive and I'm going negative $1, then this becomes a negative as well, right? All right. So gamma goes with delta, the G's. Gamma goes with delta. And theta is simple enough. Theta is time, right? So what theta tells us is every day that goes by, the clock is always ticking. Theta erodes the premium. So, you know, a half a day goes by, we lost 3 cents, right? If we only have a half a day, we lost 3 cents in theta. Okay, theta is always going to be negative to the premium. All right, so tomorrow, all else being equal, this premium is 153 right now. All else being equal, the underlying doesn't move, volatility stays the same, everything's equal to the penny. Tomorrow, this premium will decrease by 6 cents, so we're going to be at 240. The market would probably be like 247 bid at 250. Okay. So theta is the thief in the night. Theta is the thief that steals your premium, or theta is just time decay. On the floor, we used to call theta the thief. He's constantly just picking away at your premium. He's like the guy in the orchard just stealing your apples. You don't even realize it until they're all gone. All right. So theta is the thief, or theta is the time on that one. So theta is the impact of time on your premium, and it's going to erode it as the days go by. And vega is a measure of volatility. All right, vega is volatility, but what the heck does that mean? Well, vega, when we pull up the option montage, we've got the vega over here. So it's 16.04. This basically, it's an increment. It goes up by 1%, right? We go up by 1%, and now we're at 1704. Sorry, 1704. Jeez, 1704. Well, these premiums are affected by that. We increase by 1 percentage point. So for every increase of percentage point, 18 cents goes in here. So all else being equal, tomorrow a day doesn't go by because that's going to erode the theta, right? So time doesn't change. The price doesn't change, but just the volatility upticks by 1 percentage point to 1704. That means this premium would increase by 18 cents. So that would put us at 271. Please check my math on that. I'm doing it in my head. So 54 and 18. That's off right there. It's 272, right? 272. So just that 1% increases our premium by the 18 cents. So every increase, obviously if it's 2% increase, it's going to affect it 2 times that volatility coefficient. Okay, why are all these things important? Well, ultimately, all of these things are the determining factor to our strike location. What type of strategy we're going to use, whether we're buying strategies, selling strategies, and where we are going to go in the strike locate or in the option montage. Sometimes we're going to be picking the 29 days to expiration. Sometimes we're going to be picking the 200 days to expiration. All of those things are determined by the environment and my rules as to where we're going to go on this stuff, right? Online, they're just going to tell you how you do it. With this one, poor man's covered call, you buy in, a further expiration cycle in the money put or something like that, or in the money call, and then sell another out of the money call, and there's your poor man's covered call. Well, that's not it. We have some rules that we need to follow in order to implement this strategy. It does not always work for this strategy. And the reason why is because, you can set this strategy up to where you are at a loss immediately. I've seen it where people can build this strategy where it is wider than the spread. So, if it's a $10 spread, they're paying $10.01. Well, they've locked in a $1 loser. Don't let yourself fall into that trap. It can easily happen, especially with the different volatilities and stuff like that we're going to have to manage. All right, so those are the option Greeks, if you will, the quick and dirty. Vega is volatility. Theta is the thief that steals your premium. Gamma goes with delta, all right? So pretty basic there. Now, the first thing we need to do is come up with our market directional assumption. And with that being said, my thing doesn't want to work. So, for instance, we see, let's just say I had a chart that's supposed to pop up here. I don't know if it's going to pop up today. So basically, we've got a chart and we see it kind of doing this, and we think we're getting ready to break out for whatever reason. Maybe you think it's going down like this and is ready to snap up, okay? Whatever the fact of the matter is, we need to know our direction, and our idea is our directional assumption is to the upside, all right? Now we need to start asking ourselves, because we don't know we are going to do the poor man's covered call. Nobody goes in and says, you know what, today I want to implement the poor man's covered call because, X, Y, Z. I have no idea why I wanted to. We are bullish. That's how we come up with this stuff, right? We look at charts and we see that we are going to try and find a chart that is, find a chart that doesn't look like this for some reason, and I can't get off of it. So, we want a bullish assumption. So now we need to start thinking, okay, I've got a bullish assumption in X, Y, Z because it wants to go higher. Now, how do I get to the poor man's covered call? It's not like I'm trying to. I'm just going to go through some rules here to come up with that. And I had this thing on for like a transfer, and it's not wanting to go for me. So give me a second here. Let me play around and go through a couple of things. So first off, we come up with the directional assumption. There we go. I always forget I got to kind of do that. So first off, we come up with the directional assumption. Let's see if my chart came up. There it is. That's what I wanted that to follow up, but my thing was, so maybe we thought, all right, we're breaking above this line or whatever, and we became bullish. However that comes up is what I was trying to, that was the chart I wanted to play around with. It doesn't matter what it is. But the poor man cover call, a couple of things we need to know. It's not a diagonal spread because we're going out further in time. We're also using calls on leaps. Now, most people set this up with leaps, which are long-term anticipated securities. That's usually 360 plus days to expiration. All right. That's what most people are going to look at. I don't do that. My leaps are, somewhere around 6 months-ish, okay? And I'll go shorter, I'll go longer, but my idea with this one is 6 months-ish is the long call, is where I'm looking for. And the poor man's covered call is not a calendar spread, because the calendar spread we're going to be using, if we use the 24 strike in Dece, then we would be using the 24 strike in June. All right. So we're using the same strikes on the calendar spread. On this one, we are building it out so that we are trying to create, we did the synthetic long stock last week, right? Well, this is another way to build out a synthetic long. But remember, last week we were worried about the upside and the downside, right? Because if the market goes to zero, if with the synthetic long, if the market went to zero, we took the entire loss there. This, we are going to have a synthetic put embedded in there to where once the market goes down to a certain point, just like with a put, we're out at that level. The nice thing with this strategy versus using a put on a strike or a call, think about it. Like, you're in this strategy, the underlying trading 150. I'm doing the 125 calls, right? So my risk is only to the 125 calls, and below that, I have no more risk because of the synthetic put I have on, all right? Well, if you were to buy a put, that increases what you paid for that underlying. We're not doing that with this. The other thing is with the synthetic long, even if we had a stop or something like that, if you bought the stock, say we bought the stock, and I bought the stock at 150, and I put my stop in at 125, right? Just kind of like we're building out this strategy. Our risk is down to 125. I put my stop at 125. But the market opens at 100, all right? Not that that's going to happen, but maybe it does. It opens at 100. Well, your stop executes and you're filled at 99. Fill 'em and bill 'em is what we used to say on the floor. You're filled at you're filled at 99. Well, with my strike, I'm out here. Or if you had bought the puts, you're out there. Okay. So that's the beauty in options, is you really know where you're getting out. The stop, it's wherever. It's unbeholden to anything other than trying to find something. It's just a runaway train. So here we are going to be able to know exactly what our risk is. Where a stop, you don't really know that. Yes, you get the haircut. Okay. All right. I got to remember when I have that markings on, I can't do it. This is a bullish strategy. Remember, first thing we came up with in that one was we see a chart that's doing this and we've decided, okay, I'm bullish in XYZ. Now I need to figure out what kind of strategy I need to put around this assumption. And that's what we're going to basically do. That's what we're going to do here. Sorry about me saying, for some reason, basically is stuck in my head today. It's like drink every time he says basically. No, please don't. You won't get through this webinar. All right, using options in place of stock. I've mentioned this before. Some of the benefits. These are some of the benefits. The stock, we're down to zero. We have risk if we bought the stock. If we had the stock, we have to put up a lot of margin on $100 stock. I buy 100 of those. I got to put up $10,000, right? Some of you guys might be able to do it on margin, so I'm just going to put marge. If you got marge, sometimes they'll let you get out for 5,000 on that margin. So, I have to put up half of it. Well, with the options, I'm going to be able to do this equivalent for about maybe less than $2,500. So much less margin using the options. All right. And we're protected to a certain level and we take out all the way to zero. That doesn't matter to us. Okay. Do earnings matter? Banu, yes. We are in the middle of earnings season. And, even in my earnings webinars, I talk about like the poor man's covered call, the synthetic, not really the synthetic long necessarily, but calendars and stuff like that, because these are actually great strategies right after earnings have happened. And we're setting this strategy up for the next earnings cycle. So this is coming in at, a pretty darn good place, really, because we've had some earnings. It's not going to fit with a lot of them because I don't really want to sell a short call right now. We have earnings going on. I don't want to sell my short call right now because we expect volatility to expand going into those earnings. So, yes, you will have to trade this. One of the downstrokes with the poor man's covered call, because we're going further out in duration, is we will probably have to be active in the earnings cycle. But that's only on our long call. We're only going to be having that long call, the long call for earnings, okay? And that's only if you're very bullish, all right? And you really want to hold this on. I would say cover it before the earnings, no matter what. Because this long call right before the earnings is going to get the highest level of volatility. After the earnings event, that little $ earnings event, or whatever the symbol is, volatility just tanks. It's called the crush. We used to call it the volatility. That's when you get volatility crush. And remember when I was talking about that 1 percentage point move was worth like 18 cents in that one example? We are going to see like 10 or 15% moves afterwards, sometimes 30% moves after that earnings, that crush. This might be trading up at around 40%, and then it goes down to 10. You got that 30% drop. Well, think about that. 30 times the 18, it's not going to be completely equal, but you can see that we were only talking about 1 percentage point move, and 18 cents is a lot. And now we've got like a 30% move. That's huge, okay? So that's what we try to capture when we're trading those options around the earnings. I would stay away from that because you could be directionally right with those calls, but you have to make up, like the market's going up and market's going up on those, but your calls, because of that volatility crushing, they might stay the same price. I went in, I paid $2, and even though I got this massive move higher, this volatility crush lower, it's still worth $2. So there's a lot of occasions where you can see that. You could even see it where it's only worth $1 now. So stay away from that. All right. So options used in place of stock, reduce risk. With the pin, I get a little ahead of myself, don't I? I'm way ahead, and I'm forgetting to read some of your guys'. I don't think I've missed anybody so far. Reduce capital requirements. I already ran over that, right? We talked about that. The $100 stock. If you bought 100 stock, and all of the other things to make it equivalent, you'd have to buy the put too to make that. But if I did the $100 stock 100 times, that's $10,000, outright. And then if I buy the put, I buy, say like the 16 delta put, let's just say on a $100 stock, that's probably going to cost me somewhere about 60 cents, right, for those puts. And buying these puts increases my break even. Because I paid for this financing, that increases it, So if I bought this at $100, really my break even is $100.60 by buying that put. That ends up being, break even. That ends up being your break even. If you were to do this stock with the put, all right? What we're doing is we're building it out so that we're going to reduce our capital requirements on margin, and we're embedding a synthetic put in there so we reduce our risk to the downside. And you can create a more diversified portfolio. If you guys remember when we were talking about the synthetic longs and synthetic shorts, if I have a finite amount of money, whether it's a $10,000 account, $100,000, even $1 million accounts have this problem, okay, on diversification. They want more. Everybody always wants more diversification, right? That reduces your risk the more you're spread out. Well, if I only had $10,000 in my account, well, when we were talking about that $100 stock, being $10,000, well, that just ate up the entire portfolio. on a $100 stock. And now you're stuck with like trading penny stocks or high risk there. Well, with this one, you know, you can see with options, you know, you get 4 times that leverage. So you'd be trading, it feel like you're trading with $40,000 in that account. Okay. Or in this case, you know, you get that margin, you're trading with $4 million. Right. So a much more diversified portfolio of securities with this type of, if you're using options in general. Okay. And you have a higher probability of success with this rather than just having your stock on. All right. Because the probability of success with the stock is only about 50-50. The probability of success with this one is about 60%. So it's just slightly better. I'm not saying this is knocking it out of the park on probabilities, you guys, but it is slightly better than just going out there and buying stock. Okay. Your return on capital is higher. Remember, like we talked about that just a minute ago. If I buy 100 stock and it costs me $10,000, okay, or I buy 100 synthetic of the underlying and it only costs me $2,500, but for every move higher, we capture a greater amount of that. And this one, you're not going to get that dollar for dollar move like we talked about with the synthetic long, but you are going to be getting, you know, about, 70, maybe 50, somewhere between 50 and 70 cents per dollar move. Okay. But we have, you know, a third, not even a third, a quarter of what we're putting up for it. So this 50 and 70 cents is a greater return on that capital over here, on this 25 than this dollar is on the 10,000, right? This will affect you much greater than on the 2,500 than this will. Okay, so my investment over here, where I only had to put up $2,500 for that 70 or 50 cent gain, is better than $1 on 10,000. Okay, so our return on capital is going to be much better. Just like with the synthetic stock on that one. This Banu is where we were talking about. This is one of the disadvantages is we got to stay active during the earnings. All right. And that is only on that long call. All right. We don't want to have to be the short call. The short call is a big no. All right. And I kind of put that in here with the long call. I'd try and get out of that as well. Right. The long calls will eventually expire. You know, if you bought the stock, you can have that till they go out of business, to be quite honest. With the long calls, depending on your option, they're always going to expire. There's no way around that. Sorry. I struck that somehow. So the long calls will eventually expire. There's no way around this. Options always expire at some point. But as traders, you know, investors are a little bit different. Like if you're a long-term investor, that's great. It doesn't mean that you can't trade a percentage of your portfolio, which I highly suggest. I'm not ever suggesting using your entire portfolio around these strategies either. You got to mix it up. Have some of your, you know, blue chip stocks that you have in there that you're getting your nice dividend from and stuff like that. Some low risk stocks, right? And then this is part of your higher risk portfolio. All right. So part of it is your long calls will eventually expire. That is a downstroke. But when we're trading around these types of moves, like all of a sudden I'm seeing something's bullish. Well, I'm not bullish the next 10 years. Who has a 10-year horizon and knows what the heck, you know, Xerox. Like who thought Xerox was going to be gone, or Kodak? Like who knows even what Kodak is? Like that was a blue chip stock that people thought would never, almost had as much money as Apple at one time, and thought was never going to falter. And sure enough, now times change and they're the buggy whip. All right. Forced assignment. That's on the short call, right? If it blasts up through our short call, that's the only one we have to worry about on our short call, right? Because we have the obligation to give them that, or for that, to take delivery of that call. But remember, we've got that long call that hasn't expired yet. We can always force assignment on whoever also, so we can offset that. So, I'm now long the stock at, X price and short the stock at Y price. So I've made up the width of that spread. It's the same thing. So people are always worried about this short call. Oh my God, I'm going to get assigned on it. For one, we're out of this trade as soon as it comes up and hits that short call, right? That's going to be one of my rules, is we're out right then, because we've beaten the probabilities and we are at our profit target at that point. I'm never trying to get the full width of the spread in collection. The reason why is because if I'm getting the short call, I got to worry about that assignment risk, and I don't want to pay for that assignment, right? I'll do it, Banu, in a second. All right. And you don't receive that dividend. That is also a downstroke. If you are really reliant on receiving a dividend for income and stuff like that, then you aren't going to get that dividend in this. I look at getting dividends with stock as that collection of premium. I'd rather get that every month than every quarter anyway. So you don't receive a dividend. And if that's a downstroke, then, I'm not going to be in this strategy long enough to have to worry about that dividend. It only comes up every quarter anyway. Like, I'm only maybe going to be in this strategy for 1 or 2 months. I'm never going to even worry about that dividend. It's never going to come in. All right, rules of thumb. You must have to have the tight bid ask on the option montage. And this rule comes in closest to 35 days to expiration. That's what we're looking at. Tight bid ask, 35 days to expiration is the rule. So let's pull up the option montage, and 120 days, what we got here. So I've got a bullish assumption, let's just say an IWM. So I need to drop down the option montage. This is the closest to 35, I said closest to 35 days to expiration, right? Days to expiration, that's this one. So option montage, then I go down there, scroll it down to the ones that are closest to the at the money. I don't want to really look at the ones deep in the money because they get a little bit wider, but these 35 days to expiration, the ones that are all extrinsic value. Remember, options that are in the money have intrinsic value. That's what they're worth. Options that are out of the money are all extrinsic value, and that's all of the theta and the volatility pumped into those. It will, if this underlying for the next 29 days stayed at 155.64, then these options would all be worthless. Every option out of the money, right? This option right here in 29 days, it's 155 strike. If we stayed right here, this option would only be worth about 64 cents, right? So we're looking at the ones just out of the money. And on a underlying that is over $100, like this one, move the decimal 3 ticks to the left. So 15 cents wide is how wide we should see. It should be inside of 15 cents wide to the bid to the offer, okay? And you can see this is 4 cents wide. So that easily meets that rule, all right? Our rule here is a stock over $100, move the decimal 3 ticks to the left, and then that's how much it should, how wide the bid offer should be. On any stock under $100, it's 10 cents. So if it's under $100 stock, then we're just looking at it needs to be tighter, less than 10 cents wide to the bid to the offer. All right. So we can go over here and look at something like, let's say XOM, see what they got. It's under $100 stock. My rule is 10 cents wide during open ARP. And this is during open market operations. This rule applies. This is after hours, so orders have been canceled. But you can see that normally this is going to fit to that rule I can just about pick anything over here on my watch list, and we will find that following that rule. This obviously is not working out, but it's after the close, and they've gotten a little wider. Las Vegas Sands is usually 10 cents wide. So that one makes work. 10 years ago, I didn't think GE would go down. Oh, yeah, or GE. Yeah, you're right. Who would have thought? I mean, and they're still very diversified, and they were just a little overvalued, I think. But you're right. GE, who would have thought? They would have fallen from the graces. And then, so you need to have tight bid ask here. We also, 6 months to a year out, remember, I am going to always go closer to the 6 months, right? I might even go 3 months, right? I'm not afraid. I'd rather bring in my longs closer because I don't want to pay a lot of extrinsic value, right? I don't want that extra premium, right? I'm not going to be in it that long. I don't want to worry about all that extra premium. Also, the closer we go in, rather than being a year out, is we can finance all of that extra extrinsic value. So then we have it on for the cost of the underlying. And I'll show you all that stuff here in just a second. And the other one is we don't want to pay a lot of extrinsic value. I just mentioned that. So I've gotten ahead of myself. I've done the whole webinar twice now. But with that being said, we don't want to pay a lot of extrinsic value, and we don't want to pay more than 75%. Don't pay more than 75% the width of the spread. So you can see here, kind of, let me click this off so we get that. You can see here, we have what is that? A $17.50 spread, right? From 92.5 to 110 is 17.5. So you take 1322 and divide that by 17.5, and you come up with 75.6%. So that's what we're looking for. Something for this, we want less than 75% the width of the spread. Width of the spread, which is the symbol we used to use for spread. So 75% the width of the spread. And what else we got? Use lower volatility stocks. One thing what we really don't want to feel with this stock is whipsaws. Boom, 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 like a Tesla or something like that, where it really doesn't go anywhere, but it's just all over the place. I would much rather see something go like this. Right? Just one of those boring stocks. All right, yeah, what do you do? It's just going to continue to trudge higher. Because that, like a 45-degree angle like that, just trudging higher, will allow our short calls to expire worthless. Whereas this, when we get those big swings like this, it's like, what is going on? You're in and out of it. The emotional swings on that are just not going to be fun. All right, I keep losing my cursor. So were you not like implied volatility percent? Somebody's asking about implied volatility percent, which is usually what I talk about. I just mean volatility. For implied volatility percent, which I think I'm going to be talking about, implied volatility percent, which is one of those major things I always look at, implied volatility percent. I want it to be mid-range, right in the 50s, where we don't know. Volatility could go up, volatility could go down, but we're not all too concerned about it because we're going to kind of offset a lot of that. So that being said, implied volatility percent is different than just implied volatility or just the volatility of the stock, right? So we don't want ones that are swinging all over the place, like tech stocks and stuff like that. Usually aren't the best for this particular strategy because you get those whipsaw moves and stuff. One day you're making money and the next day one day you're eating steak and the next day you're eating peanut shells. But implied volatility percent somewhere around an IV of 50. And then we also want to sell the near term out of the money strike, which is going to be, the near term out of the money strike. So we're going to be selling right in this little wheelhouse over here. So we want to sell theta. So we want that short call to decay quickly, right? If I sold it at $1 or whatever, I want that thing to go to zero as fast as it can. And then we're going to be buying our long call out here. Okay, so we have much slower theta decay. And if we use this call to sell off all of that theta decay, right? If we use this call to finance all of that extrinsic value in theta decay, then we don't even have to worry about this with the call. All we have to worry about with this long call is our bullish assumption, me being a bull, right? So we're selling that near-term strike. Make sure Vega is not a big difference. That's volatility, that Vega number that I was talking about. I'm not talking about implied volatility, but each underlying has its own volatility coefficient that's going on. Remember, I was talking, we were going to be buying out here. I might even be looking at some of these June, which are nowhere near a leap, but that's going to work with my rule. So what I was talking about, make sure there's not a big difference in Vega that's between here and the ones that we would be buying, okay? And we want less than a 3% difference, okay? So we've gone from, let's call it 24 to 29. That's a 5% difference, okay? To this one right here, this might be the one that we have to do, right? Because from this volatility to the 26, this one must have the earnings in it, is only about 2.5%. All right. The nice thing about using this one, if it has the earnings in it, we know volatility increases going into that earnings event. All right. So our max profit is basically there's that basically, who's right? The width of the strikes minus the debit. Remember, what we're looking at is with this one, let's just say we're looking at a $10 wide spread. Okay, it's $10 wide. 75% the width of the spread. We're paying $7.50. We pay that debit. All right. Well, now our max profit is $2.50. We're going to be looking to take less than this. All right. As soon as my short call gets touched, remember I said that's where I'm going to be looking to get out. So in that, we're going to be looking at getting out when it increases by about $1.25. That's my profit target. All right. Our max loss is the debit paid. So whatever we pay for we're going to be buying the 84 delta in the money call, longer duration, 84 delta in the money call, and then we're going to be selling about a 36 delta out of the money call, to help finance that extrinsic value. So our max loss is going to be ultimately what we paid for the entire strategy, okay? That debit we paid. And it's going to be whatever this strike is, its intrinsic value, what it's really worth. So you're not paying for a lot of fluff. And our break even is going to be the call strike price plus the debit paid. And I'll go over this. Volatility can affect the break even as well. So as volatility increases and decreases, that can affect us. Obviously, if it decreases, that could hurt us. If it increases us, that's going to help us because volatility affects longer duration more so than, yes, low beta stocks, Banu. Yes, low beta stocks, a little bit less volatile, correct. All right, so this is when I pull up the platform. I usually throw it out to you guys to give me some examples of stocks that you are bullish in, right? We don't want to get a bearish stock in here because we want to do the poor man's covered call. And Banu is throwing out Costco right away. So let's look at Costco. Costco. All right, Costco. Obviously, I'm bearish, Banu. and it's not working out. So I should have listened to you, I guess. So what we want to do is make sure we don't have earnings right here in this one that we're selling, which we do. All right. So that's rule number one, because we can see what happens with volatility heading into earnings is it usually starts to increase heading into earnings. This is a better example. We get up there, but as soon as this earnings happens, we get that volatility crush. All right. And if we're short a call and volatility is increasing, what did we talk about? That's going to increase the premium. And if we sold it, we want it to go down. All right. So we want to stay away from this earnings or earnings landing in this month. If this earning right here was right here, that would be great, right? Because then we have this whole month right here that we could short that call. Volatility is not going to affect us as much. And we would have this clean month where we're just long that call, okay? So I would pass on this one and wait for just after those earnings if you're bullish, all right? Who's that? Ralph threw out CSX, all right? All right. All right, CSX just had earnings. They must have done pretty good. They beat on earnings estimates. So we're bullish on it, right? And they're not going to have earnings probably out until we get out here. So I'm got a couple of free months that I can play with. So I want to sell this month and probably start with buying this August. That might be a little far out with the volatility because look, we got 8.5 to 2.5. That's, we got 4.5 that or 4-point move. So I want to stay away from that. This one is a little bit closer. Let's just take a look at this one. It's a little bit closer. I have less than the percentage point. It's under $100 stock. So it needs to be inside 10 cents to the bid offer. We would look at this in open market operations. Another way to look at it to see if you probably would have a lot of volume and open interest, or a lot of volume and open interest indicates that you will normally have tighter markets as well. Think about it. If there's a lot of open interest, there's a lot of eyeballs and a lot of people trying to make markets better than yours. So let's just say that fits the rules there. So we're going to take a look at one in the money. What I say, we're looking at the 84 delta in the money option. So let's look at the deltas. We're looking at the in the money here. Closest I've got right now is 83. I'm going to lean to moving a little further out for this premium here. So I'm going to go to the 86 delta. 84 delta just gives us a starting point. And the reason why I picked that 84 delta stock, you guys, is 84 delta when we have the bell curve, which that's not a very good one. The 84 delta or the 16 delta is really, the 16% probability lands right here. And basically, if the underlying's here, this would be equivalent to an 84 delta and a 16 delta, right? So it's basically 100 minus 16 is 84 when you're in the money. So we're looking for that 84, which is a 1 standard deviation move, pretty unlikely occurrence. So I'm going to be doing this one. Obviously, I would have to check the markets during open market operations. It's not going to even be close. Let me just see what the last was on this to see if I can come up with something that would be close. So let's just say we paid $7 for this one. I'll figure it out. So if I'm looking at, I'll figure out what it's worth. So when we pull this up, this is 70. It's worth $8. 70, this 70 strike, which is what we're looking at, right? We're looking at this 70 strike right here. 70 strike. It's trading 78.89. So this strike is actually worth $8.98 because you take the difference. Whatever 70 is to get to here is what it is actually worth. It's only worth $8.79. My guess is during open market operation, this one's going to be trading right around $9 and let's say 45 cents. So I need to try and collect 50 cents to cover my extrinsic value, right? Because we talked about in the money options have intrinsic and extrinsic. The intrinsic value is what this stock is worth at $8.79. Everything else is extrinsic, theta decay and stuff like that. So we could say that the extrinsic value here is about 50 cents. So in that regard, the closer to the money I'm going to have to go, about that 36 delta, we're going to have to go a little bit higher and go to the 40 delta. So we bought this one that was in the money for $9 and we collected this. So we should be looking at, it must have gone middle of the road. So what did I say? $9.50 plus selling that dollar. So that's about right. That's about right. The way it all broke down, somehow giving me the middle of the market there. So $8.62 would be about right for that. Now, what did I say? The next thing you would do is look at the width of the spread. We got a $10 wide, $10 wide, and we're paying $8.62. That's too wide, right? Because that's 86% the width. Too much. We're paying too much money for this spread, right? So that doesn't work. We can see our break even is $78.62, which is another perk with this strategy because look, I could pay $7 in some sense. $78.62. The underlying is trading $78.97, so I'm able to buy it below. But it doesn't fit my other rules, so don't do it. You're risking way too much money for the amount of reward you're able to get. So in this, when we came up with, we just had a bullish assumption, and we're going through all these steps, and you think, okay, I'm going to check out the poor man's covered call, and you come up with this and say, all right, shoot, it doesn't fit the rules. Then, there's a better strategy for this underlying, maybe the synthetic long that we just did last week, right? That would be the next step to go to it. You're going to have to take a little bit more risk, but without having the protection to the downside with the synthetic long, right? Because we have risk all the way to zero. Whereas this one, remember I talked about the 70 strike here. We don't have any risk below 70 because with the option that I'm buying, remember, we have the right but not the obligation to take this call, all right? We can if we want. We don't have to if we don't want to. So if we don't want to, when it's trading down here at around 50, tomorrow it opens up at 50, my only risk is here, all right? Whereas, remember, that stop would be set off down here at 50 if you had a stop with the without the synthetic put embedded in there. Okay. All right. So that one's not going to work either. Somebody else threw out FedEx. Let's take a look at FedEx. All right. So FedEx, we don't want earnings. They just had earnings. Their earnings probably are going to be landing out here. So we've got a couple of clean months we can live with. All right. So let's go out the option montage. It's a $200 stock. So we move the decimal 3 ticks to the left, 20 cents wide. You can see we are meeting that rule even after, for the most part, after open market operations. But that rule should apply only during open market operations, making that determination. All right. And then we're going to go out. Let's just stick with the July for right now because I got it open. Let's look at, let's say, the 175s because that's the 84 delta. We're going to be buying that one. One option trader hack I'll give you right away. Right here, you look at the corresponding puts. That's the extrinsic value of these. So we've got somewhere around 175 to 98. So I'm just going to do the math on it. So $23 is intrinsic, so $23. So we got about $1.50 ish, right? 20. If we go to 99, that's 24. So $24 of intrinsic value, $24 of intrinsic value. So we've got about $1.50 to $1.75 of extrinsic value, right? So that's what I'm looking at. I need to finance about $1.70. Only thing we got here is this 210 call. So let's try that first. So 175 to add in 24. Our break even is now 199.05. We're buying it just slightly above where the market is. That's something that you're going to have to determine whether or not you want to make up that difference. So we've got, let's see if the rest of the rules fit. We've got a $35 wide spread, right? $35 wide, $24.05 divided by $34 wide. Is that right? $35 wide. And we come out with 68%. Somebody double check that for me. I do that right? We've got $35 wide, $25. Yeah, so that's right. So that fits the rule, all right? We can do that. One thing to note, you're going to have to realize that my break even is a little bit higher than when the underlying is trading. Sometimes we can get it lower, but sometimes we are not able to do that. So we could look at doing the 70 strike to make sure we pay off all of it, because the 70 strike only has, what is that? $30 in it, $29. So 29 to 31, we've got $2 in extrinsic value. We could try that one as well. Break even is 28.99, 28.93. So 98. It's still about 85 cents higher, right? Because I'm at 198.93. You add this into the 170, 198.93. So we have to go a little bit higher for that. But we have a $40 wide strategy. $40 wide strategy. We're paying $29. We'll just round it up. $29 divided by $40 wide and 72%. Okay, so it still fits. I think I'd go with this one rather than the other one, maybe. Okay, somebody else do TLT thinks that the market is in the toilet. This probably be very close. All right, so TLT, we go to the 84 delta in the money call. So we're going to go look at the 84 delta. One of the things we needed to do at TLT fits the rule, right? We move it 12 cents wide. We can even see further out here, this far out, we're meeting that rule. So we're in the clear. So we're buying the in the money, 84 delta. We know that we need to get about 20 cents in premium to cover that, because we're paying $7 plus the 16. We're at 123.60. So we got to at least pay off 60 cents, maybe 70. We're going to probably shoot for 60. So we come down here, 36 delta we want to sell. That's about as close to it as we can get. So we're going to pick that one. I usually move a little bit further out also, you guys. Give myself a little bit wider spread. So we're at $8 wide. And get my calculator up again. So we've got $6.64 divided by that $8 wide. Is it going to work? 83. It's a little wide. Okay. So that one might not fit the rule. You could move this out. Oops, let's do the 16s further out. Let's go a little, sorry, let's go to the 125 calls, sorry. Let's do the 125 calls first. Now we're at, our break even is 122.95, 122.95. So we're only 5 cents, our break even is only 5 cents higher than us. And then we've sold this one. We've got a $9 wide strategy now. So we've got $9 wide on this one. Sorry, guys. $6, it's not going to work. Divided by $9, I can tell you right now. 76, it's close. You know, that's close enough for government work. If everything else is working, you're wildly bullish, then, you know, this might be a yellow light where it's a little bit over what Wolfman said, but it's close enough for government work. I'm going to go with it. All right. And then, you know, you're going to cover, knowing your exit strategy, you're going to cover at 50% of my max profit. So on this $9 wide, I'm paying $7. So I've got $2 in profit. Once this is trading around $8, that's where I'm going to get out. And that will happen when I get hit, when I get kissed on my 124s. I will be at my max profit. So make sure you're looking for that. Yes, and Banu says maybe you can go out a month. Right now, the way that the timing is set up, the delta or the premiums we're getting in these front months are not very good. So, oh, and one thing I forgot to mention is when I was talking about the difference between the 2 months, right? We were buying this the percentage here is on the increase. Remember when I was saying 2 to 3% increase? If this premium is, or this volatility is higher than out here, then we're in the clear. It's only an increase because think about it. When we're buying out here, if this is a buy, we're buying this volatility and we're buying this volatility up here. And we don't want to pay a lot for this volatility and not get the collection where we're selling here, right? Because we're selling this volatility. We don't want a big difference here, all right? If it's less than a 3% increase, that is good. If it is a decrease in volatility, like volatility starts going down the further we go, then that is all okay, all right? If this was 8, 7, 6, or whatever, then that is decreasing. That means we're in the clear, all right? Does anybody else have any other questions? It's pretty simple, right? I mean, we're buying the 84 delta in the money. That protects us below wherever that strike is. We try to finance by selling that call all of the extrinsic value. So we have time to be right, even if it's trading sideways. Like we're trying to pick a boring stock. It doesn't always go straight up, right? It's going to slowly trudge up, kind of like this curve. We might see it during this time. Well, we don't want to lose money when the underlying is trading like flat like this. And that's what happens when we pay off at that extrinsic value. And then we get the move higher and we get paid off, right? When it's trading sideways like this, that call expires worthless for zero money. And that's what we want. And then we gain on this, our long call going higher. I got to get better at my drawing, don't I? All right. You guys like the drawing or no? Does it make it more confusing or less confusing for some of you guys that have been around for a few of them? I've been using more and more of the drawing. Please comment in the boxes below. Like, tell me if you like or dislike it. You know, about the, you want more? You want more cowbell, more pin? Let me know. All right. All right. So for you guys that have been works for me, good. All right. I was hoping it would help people out. All right. So we finally got the link right. I have finally mastered how to copy and paste the link. So we've got this trading course. It's the 2-for-1 right now. And you're going to be able to get all of these. Actually, usually we do these for sale where we do the 2-for-1, where you get this one and this one. But I have butchered the link up here so bad, so many times that they finally were like, Wolfman, you can't screw this up. So for $4.97, not only are you going to get these two, we're going to kick in 2 more for you. And that is going to be on the how to trade the options like the Wolfman and this option series here. So you get basically another drink again. You get the option hacks, volatility crush. So this option hack streamlined your process, just like I gave you one of those right away. It was looking at the corresponding put to see what the intrinsic value or the extrinsic value of an in the money option is. Look at the corresponding put or the corresponding call of those in the money options to see what the extrinsic value is, what we are going to see decay all the time, the thief. To see what thief is going to steal from us. That's what we need to know, right? So the hacks is going to streamline your process. You're not going to have to do all the math in your head for all these different things for the options, montage, and many other things. And then over here on the volatility crush, this is where the bulk of my trading money comes from, is volatility crush and how to take advantage of it, all right? So one of the major ones to look at are the implementing your shortcuts here. Great one over here is the history of volatility in the crush and how to trade historical volatility versus implied volatility, calculating the volatility crush. Knowing that before you get into it is a major thing we need to know. Also, we're going to be throwing in the this one here, which is the history of options. A lot of other great ones going on in this one. One of the major ones that I want you to look at here is protecting your portfolio against rising interest rates. Nobody trades their bond portfolio and should. It's 50% of your portfolio, guys. Protect it. Up here is this link. Some people are asking why I didn't add it to the chat window. There it is. I just did. The chat window has this link, so you can easily click on that. I know a lot of people can teach you some of this stuff, but I believe that I come from a teaching family, so I hope that you guys will be able to learn to trade from me through my teaching style a little bit easier than maybe somebody else. How to trade gamma, market profile, one of the most important things I trade. This is what we trade on the floor. We called it Stoudemire. You know, I don't trade a lot of other things around, but I watch that market profile. You remember me talking about me having my psychology degree in high school or in college? Well, I believe the market profile tells us what the entire psychology of the market is thinking, all right? So you're going to get all 4 of these packages for the $495, okay? So all these pricings are out the window. We're giving this all to you for the $400, and you get all 4 of those packages for $497, all right? Everything all included, $497. If you're watching this right now, or if you signed up for this webinar, we're not giving this to everybody else. You're not going to find it anywhere on the platform other than by using that link right here. You can pause the presentation and type this into your URL, or the easiest thing to do is go over there and click on that chat window. So what do you say? If you guys have enjoyed this, learned anything at all, you know, maybe you already knew how to do the poor man's covered call and I taught you something new. You are going to learn something new in every single webinar that you watch from me. I can almost assure you of that, all right? Can't make any guarantees in finance because they don't let you. They will slap your wrist very easily. So take advantage of that wrist for $497. You get over, like, easily, I'm just ballparking it, over 70 hours of content with this deal. And one of the beauties in it is we have it set up to where you can easily check off I've watched this one. So basically I just check off the window, and next time I come in, I can see I've already watched that one. And maybe I want to skip down here. I want to do gamma. It checks it off. You don't have to do them in order, and you get to keep those forever. So, you know, if you go on vacation next week, you don't have to worry about, oh my God, well, I've only got this for a month and I've got to watch, you know, hours and hours of Wolfman, like, screaming at me. I can only handle a couple a day. No, I'm kidding. But, you know, you can take it at your leisure when it pops up and pops into your head when you want to do it. So take advantage of that. I appreciate you guys sticking around a little bit longer. I know I love to talk and always have a tendency to go over. So the guy that was asking me, Manuel, he's already gone. He was like, for purposes of the webinar, how long is it? Well, it's longer than what I originally said. So there you have it. Thank you guys all for putting up with me. I appreciate all the back and forth in the webinar. I think it helps me present better. It does maybe make me jump a little bit around, but I want to make sure you guys are clear of concept going forward. So that's all I got for you guys. Other than, if you can't take that, take it easy. Take care, guys. All right, I see a couple people throwing works for me. Amaro said, love your drawings for clarification. Thank you, Banu. Nice presentation. Thanks, Doug, for all that. I'm not going to read everybody's nice comments. I appreciate that, everybody. If you have a synthetic position on, do you ever sell puts for income if you're bullish on the stock? Okay, if I have a synthetic long position, Ralph, I'm probably not going to sell puts necessarily. I guess if volatility, let's say I put on this synthetic long position, and, you know, 2 months go down the road and I'm still bullish in this underlying, but now we have really high implied volatility. Well, that high implied volatility didn't hurt me or help me in my synthetic long position because we talked about that. We've all said all that stuff, right? But Now I have a high probability strategy. Yeah, I might add to that position. You know, I have no problem adding to winners. I don't even really necessarily have a terrible problem adding to losers in some regards if your assumption is still bullish, right? So I don't have a problem with either one of those. So I would say that's adding to a bullish position. And I would say by selling puts, you are not throwing bad money at good money. You're throwing good money at good money in that regards. All right. JQ, take it easy, bro. Ted, are you going to be around on Monday? I was wondering if I could call and discuss matter with you. Yes, you can give us a buzz. Give me a buzz. I'm around on Monday. Mid-afternoons are best for me. You know, that's one thing, you guys, with the premium membership, you guys have unlimited access to me. If you were bearish, would you do this in the reverse? Buy the in the money put and sell the out of money put. Glenn, great question. Yes, you can do that as well. And I'll be going over that one. It'll probably be landing in our, when we have a negative or a bearish assumption. So you can check that out too. All right. I am going to stop recording now.